Welcome, everyone. Thank you very much for taking your time out of your day to join us on this webinar about lending for NDIS property. Just a little bit of housekeeping. We are actually recording this webinar, and everyone who has logged in and registered will be sent a copy along with the slides, the presentation. With me today is Min from our office. I'm Debbie from NDIS Property Australia, and our special guest speaker, Paul Grant from NDIS Lending. Welcome, Paul.
Morning, Debbie. Thanks for having me today. It's good to be here.
Yeah, great to have you.
On public holiday Monday.
Thank you for taking out a bit of time on your public holiday. It's much
All
appreciated.
good. All good.
So for everybody, just a bit of information. As I said, we're recording this. You will get a copy. But if you've got any questions, just down the bottom of the box is the Q&A. If you want to just pop your questions in there. Min will be monitoring those questions throughout the presentation and answer what he can. And at the end of Paul's presentation, we will then go into a full Q&A to answer any questions that may not have been covered in the presentation. So yeah, that Q&A box down the bottom. And I think we're right to go. So I'm going to share my screen now to start the presentation and let you take it away.
Wonderful, Debbie. Thanks. Apologies, everybody. Behind my big head, you can probably see I'm an AFL supporter and I follow the West Coast Eagles. So albeit we're on the bottom of the ladder lately, there are a few premiership photos and posters hanging in my games room from where I'm doing this today, where it is nice and quiet. Now, access lending, SDA homes, NDIS lending. It's a complicated topic because NDIS lending is a specialised product. It is a loan that you cannot get from traditional banking institutions because they don't, at this stage, want to do them or understand how to do them, understand the valuation, the commercial nature of these properties, and they don't accept the rental return that they get. But for all intents and purposes, it is a home loan. There is one lender, a non-bank lender in Australia that does these via mortgage managers, of which Access Lending is a mortgage manager. And it is a home loan, and I'm going to run through the requirements to get one of these loans, things to look out for, mitigants, to get your loan approved quickly. As the summary says there, we'll go through deposits, the risk fees, serviceability, equity redraws, how that works, the costs involved, a few case studies, which hopefully will give you an idea as to type of clients that get into this, how it goes for them, how easy it can be, how complicated it can be. And then at the end, we'll run through some calculators and obviously any questions that you guys may have. Debbie's going to control the mouse today, so we'll move on to the first topic, to deposits. So with NDIS investment loans or owner-occupier, because you can do these for owner-occupation, but generally they are investment loans for investors. Minimum requirement is a 10% deposit. Okay. Some clients will go with 20%. It's probably not worth putting any more than that in, albeit you can. If you're doing it as an investment, you probably want to use either a 10 or 20%. It's not going to be a negatively geared property. It's all about your cash flow, as to how much money you have in the bank or in redraw and how much you want to put in. It will change the interest rate. It will change some of the fees. We have clients that do one of these properties and they'll put in 20%. We've got other clients who have got 3, 4, 5 of these all going at once, and they tend to go with 10% because obviously that enables them to buy more, and it also enables them to leave money in the bank for a rainy day. So yes, 10, 20% deposit is the norm. What changes with that, as it says on the slideshow, basically there's 2 different interest rates and 2 different fee structures. Everything else remains the same. With a 10% deposit, you're going to pay 7.89%. Okay, that is interest only for the first 12 months, then converts to P&I thereafter. It comes with a risk fee, or as we commonly call it, lender's mortgage insurance. That's 3.5% of the loan amount. Okay. At 20%, the rate is 7.09, and it comes with a 1.5% risk fee. You cannot avoid the risk fee. Even if you were to put in a 30% or 40% deposit, there is still a risk fee. Purely because the The way this lender borrows its money, it is expensive to borrow money for NDIS. It's not a normal house and land package, mum and dad loan. It is of a commercial nature. It costs them more to borrow, so hence they charge that fee on to the client. Next page, Debbie. Serviceability. As I suggested earlier, the banks are not doing these because they don't take the rental income that this property can earn in the future. They use a normal 3-4 bedroom house in the same suburb that you're building. What is the normal rent in that suburb? And that is what they proportion to it, which obviously affects your serviceability. Servicing on these is also can be confusing for the investor because you're told that the 3-bedroom high physical support or improved livability property is going to gross you $140,000, $50,000, $60,000 depending on location, and this loan's going to service. Everything's beautiful. What's there to worry about? And then Paul comes along and asks you for your pay slips and your financials, etc. And you think, why are you doing this? It services itself. And yes, it will service itself when it is tenanted. But before it is tenanted, guys, it is a construction loan. There is no rent coming in. There are interest repayments to be made. On completion, before, depending on how long it takes for you to tenant it, then there is a normal principal and interest repayment to be made. Hence, the property is vacant and the bank is asking you to make those payments. So yes, they do self-service when tenanted and makes a very good return for you. But until that happens, you are making repayments. Hence why we ask you for your income details, whether you be PAYG employee or self-employed. And I'll go through some of those requirements later on in slides to follow. Next one, Debbie. Equity redraw / deposit. So we said earlier, 10 or 20% deposit is what you need. That can come from various sources. You may be lucky enough to have cash in the bank, an offset facility, redrawing your home loan. You may require a gift. You might have share portfolios. You may be selling a property. It can come from all those different various sources. There's no problems in that regard. You don't have to prove genuine savings like a normal owner-occupier home loan. Equity releases. It's very important to understand if you are going to do an equity release from one of your other properties. We don't cross-securitize. So if you've got 1, 2, 3 other homes, they may have loans against them, they may not. We don't add them all into this loan and take security over the NDIS property and everything else you've got. We don't do that. We like to leave it all separate. And the reason you leave it separate, because you may want to do something with one of those other houses, and if it's tied up to the NDIS deal, it means we've got to value everything, and there may not be enough equity in that one, but there's plenty of equity in this one. It becomes complicated for you. Banks like to cross-collateralize, so they have all your houses into their portfolio. So if you want to do something, it means you've got to do everything with them. We just take security over the NDIS property. You can go and do an equity release through your bank, through your existing broker, and pull deposit and costs out of that property. Bear in mind, depending on your financial situation, your bank may not lend you any more money. You may have been lucky to be on a 1.94 or 2.5% fixed rate over those years. Some of you, I'm sure, are possibly feeling the pain of now moving to a variable rate of 6%. Your bank may not allow you to do an equity release of $150,000, $200,000 because you're servicing your loans at 6% as you've currently got them. They'll want to know what's that cash out for, and you or your broker will explain what's to buy another investment property, whether it be NDIS or not, it's irrelevant. They will then factor that new proposed loan into your servicing, and it may, just may only, cause you issues about getting the additional funds because they won't portion the future rent that that property is going to receive. But that's not always going to be a problem for you because the lender who does the NDIS deals also does normal home loans. So if you were to come to me and say, Paul, we've been to our bank, they won't lend us the money. Are you able to assist? Yes, we can do refinances and we can do equity releases. And the lender that we use for the NDIS will also be the same lender that does your equity release. And they're proportioning the loan from the NDIS future rent to your equity release, so they know that that loan has been used to buy this property. They know that property is going to earn X amount of money. They will allow that future rental income to go into the servicing calculator. So that should, in most cases, solve that problem if you are unable to do an equity release. Next slide, Debbie. Financing and purchase costs. It's always a question I get asked, and it is something we've always explained to our clients up front, so you know the full picture of what it's going to cost you. NDIS Properties through Ming and Debbie have their own calculators that will show you other parts of the transaction to do with the property. I purely just concentrate on the financing and purchase costs. They are standard. The only thing that changes is the risk fee. The application fee is $394. The valuation fee all across Australia in every single suburb and town is $3,465. Unfortunately, unlike a normal bank and a normal home loan where the residential valuation is a couple $100 and the banks absorb that fee, you are paying this cost. Okay. We do not order a valuation if your loan is not going to be approved. We only do it if your loan is going to be approved. It is a commercial report, 60 pages long, and it does value that property as a normal house with normal rent. And it also values that property for its special usage of SDA. So it will value it as a commercial property, which then obviously improves the valuation because the build on these is more expensive. You can't compare the house around the corner, which is a normal 4-bedroom, 2-bathroom house, to it, which is how a normal residential valuation is done. These are valued based upon the rental return. It has an annual fee for investment. Legal fees start at $500 for a mum and dad transaction. If you are borrowing in a company or trust, it is a bit more expensive. It can go up to $800 to $1,000 for companies and trusts. Progress inspections. So during the build, there are normally 5 to 6 drawdowns at different stages of construction. We go out. Our valuers go out twice. They go down at slab and they go out at practical completion. Most builders will send you and us copies of photos of the job as it's progressing through. We go out twice. The valuers charge roughly $500 each time, hence 2 inspection fees. We don't pay unless you authorise those inspections, albeit some of you will live in the same state to where you're building and you have the benefit of driving past it. Most of you may be doing the investment in another state, so you are relying upon those photos as we do. The risk fee, as we mentioned earlier, depending on the size of your deposit, at 10% is 3.5%, at 20% it's 1.5% of the proposed loan. Purchase costs. Again, these vary state by state. The stamp duty changes and the transfer fee changes depending on the purchase price. I've given you a rough example here of a property in Perth with a land value of $286 and a build of $629. The build price doesn't affect the purchase cost. It's just the example I'm giving you. It's based upon land value. You're paying stamp duty on land. In WA, stamp duty on $286,000 is $8,300. The registration fees are $203, the transfer is $253. Conveyancing costs. Most of the conveyances that I deal with through these transactions are around about the $3,000 mark. You may have somebody that you know that will do it cheaper than that, but I will tend to quote you around $3,500 for conveyancing. And then unknowns to me at this time are obviously rates and taxes, PEXA fees, which obviously your conveyancer will relay those to you as you move forward to settlement. Based upon that example of $915,000, you're looking at $46,840 worth of costs, which we will break down on the next page, I think, Debbie. Yep, there we go. So based upon a 10% deposit on that property in WA, deposit $91,500, the borrowing costs, which was the application fee, the risk fee, the valuation fee, the annual fee, the inspection fees, $34,576. Those purchase costs, which were the stamp duty, the registration, the conveyancing fees on the previous slide, $12,259. Total required $138,335. And pretty well, I've done probably 250 of these, and every single one of the 90%ers, which is the 10% deposit, comes in somewhere between $120,000 and $140,000 outlay. And same with the example underneath that with a 20% deposit, around that $200,000 mark is a rough indication as what it's going to cost you with 20%. As you'll see, the purchase costs don't change with 20%. All that's changing is the borrowing costs, and all that changes in the borrowing cost is that risk fee. It went from 3.5% down to 1.5%. Okay. Next slide, Debbie. Application process for success. NDIS properties are not a normal house, as I mentioned earlier, and we do not normally settle within 28 days, which you can do with a normal purchase of an established home for owner occupation or investment. These deals can take 6 to 8 weeks to go through. The reason why is, for example, as it says up the top, the valuation alone can take 2 to 3 weeks. If you're doing a transaction in Hervey Bay, the valuer is travelling from Brisbane. They don't go there every day. Same in WA. If you were doing one down in Bunbury, which is 2.5 hours south of Perth, they don't go to Bunbury every day. They are a commercial valuation. They go and inspect it, and then it takes a couple of weeks for them to do their analysis on the market as to the price you're paying, the costs per square metre of the build. They factor in the rental, and it is taking them 2 to 3 weeks to turn that around. So suddenly when you have a 21-day finance clause on your purchase contract, that's already been eaten up with the valuation. So please expect that we will be requesting by your agents for extensions to the finance clause. Finance normally takes 45 days. It enables you and I to get together, which can take a week to get our paperwork organised. The valuation is another 2 to 3 weeks. Then the lender themselves can take another 1 to 2 weeks to approve your loan. There's your 6 weeks straight away. Settlement can happen very quickly after that. Settlement is done electronically via DocuSign. So documents are signed electronically. They are emailed to you, and you sign them and send them back. So 7 to 14 days to settle after finance approval is not unusual. Back end is certainly a lot quicker than the front end. But there are ways to make sure that this does happen in a timely manner and doesn't get blown out too long. With me asking you lots of questions and the lender asking me to get more documents from you, you're getting frustrated because you're supplying things over and over again. There are ways to ensure that it does run smoothly. This lender, being a non-bank lender, they follow a checklist. They are box tickers. If it does not tick the box, they do not move to the next stage. So if I am asking you for a document and you're wondering why does he need a bank statement that runs for 90 days when I've given him one that is for 79 days, is because they want bank statements that go for 90 days. Painful, I know, but we can alleviate that up front. So we follow the checklist. If you are a PAYG employee, I will ask you for your last 2 pay slips. They have to be consecutive. Why do they have to be consecutive? After 35 years of doing lending, I don't know why they need to be consecutive, but they want the fortnight 1 to 14, 15 to 28. They don't want one pay slip in January and one in February unless you get paid monthly. They want consecutive weekly or fortnightly pay slips. They will ask you for your 2023 income statement at the moment. Why is that? You may be receiving overtime, you may be receiving commissions that don't or aren't easily determined by your payslip. Your income statement will show what you earned for the financial year, whether we're using 2023, 2022, or come June this year, 2024. So they will ask for that. As I mentioned earlier, your bank statements. And I know sometimes banks issue statements 6 monthly, so a December statement is not current when we're now in the month of March. You can do internet transaction printouts as long as they've got your name on them that matches up to an account number. And I've seen a lot of internet statements that it does not have your name on it. But if I've got an old statement, which is an original statement with your name on it and an account number, and an internet statement with just the account number, I can match it up. Okay. But if you just send through internet statements I'm going to have to come back and ask you for something that has your name on it. So if we can do that up front, it saves us time. Same with your loans. If you've got existing home loans, we know the last RBA increase was in November. So if you give me a statement to the end of December, they will ask for internet ones from January to March. They will want your name on them as well. And they will want a statement which shows the current interest rate you're paying. If you are on a fixed rate, they will want a statement which shows when the maturity of that fixed rate is. These are the things that you and I would go through up front to make sure we don't have these problems at the back end. They will ask for your passport, your driver's license. If they've expired, we will want something that's not expired. We may go down the path of a Medicare card and a birth certificate. If you own other property, they want your council rates notices, which confirms ownership. You complete an assets section on our application form. They use the rates notices to confirm that what you've recorded on the application as residential assets are backed up by council rates notices, which also confirm whether they are owned by both Mr. and Mrs. or for investments, whether it's in one name only, or if you've got a company, these investments are in a company name, because it helps us with our servicing calculator when we're working out negative gearing, etc. for other debts. Next page, Debbie. If you've got investment properties, we know that on your bank statements, you'll say, Paul, it shows rent from Joe Smith of $500 a week. They will want to see your rental statements from your real estate company that is managing your property. If you are managing the property yourself, they'll want to see a copy of the lease agreement, which confirms that the money's going into the bank statements are the correct amount that the tenant is supposed to be paying you. If you are self-employed, they will want your last 2 years' returns. And as of the 1st of March, that includes 2023. So previously we were asking you for 21 and 22. Now we'll be asking you for 22 and 23. That will also be your personal returns as the owner of the business that is paid by the business or company. They will also want the company's returns to show that it is profitable and can continue to pay you. If you are salary sacrificing on your pay slips, which happens quite often on the East Coast, particularly in the medical industry, you may be salary sacrificing superannuation. You may be salary sacrificing a car through lease payments. So we will be asking you for your salary sacrifice statements because it determines what we can add back to your income and what we can't add back. For example, salary sacrificing superannuation is normal voluntary. So we would add that back to your net income to gross you up to obviously allow you to borrow more money. With your bank statements, guys, the world has changed from when I was doing home loans back in the 1980s. Lenders now want to know everything about you. They will look at your transactions on your statements to see where you are spending your money. They will look for loan repayments to debts that maybe are not on the application. And we quite often get clients who forget that they have a GE card or a Latitude card because it was for a fridge or an air conditioning unit and it didn't seem important at the time. But they'll see repayments to those facilities and they will ask me to please explain. Happens quite often when the application is completed by either one or the other partner in the relationship. And sometimes they may not know what the other partner has outstanding. So it'd be great if it is a couple doing an application that you actually do it together without causing disputes amongst yourselves. Because it does happen, unfortunately. They will look to see if you've got zip pays. If you happen to like to gamble, they will look at those as well and make assumptions as to your credit risk ability, or do you have a problem? Shouldn't be like that, but unfortunately it is. So we tend to get those statements from you, and if we do have those types of facilities in there, we sort of say, well, let's clean those up, let's get rid of them, let's at least explain them before we submit an application to the lender. All of this will help you to get your loan prepared and to guarantee a successful submission without to-ing and throwing, backward and forward in, and obviously everybody getting concerned as to why there are so many questions being asked. Next step, please. Thanks, Debbie. Case studies. The Min wanted me to go through some case studies. Some of these studies may look similar to your own situation. I have made these up based upon previous applications. Tried not to make it too complicated, just to give you a rough idea of what types of clients apply for NDIS loans and the types of income or issues or ease in which we can get these transactions through for you. Out of the 250 of these I've done, there's probably only been 4 that have been knocked back. And the reasons for those were probably, let's go back 12 months, self-employed applicants and who would not need me to tell them struggled during COVID, and their financials for 21 or 22 struggled due to COVID. So it's probably the only reason these loans have been declined in the past. Everybody who seems to want to get into NDIS is a seasoned investor or an owner-occupier with lots of equity, good jobs, and these loans do get approved. So unfortunately, COVID probably hurt us all a couple of years ago. John and Mary, so they are PAYG employees. They work for somebody else. They have good jobs. They earn $90,000 each. They've got a house worth $900,000. They owe $300,000. They're on a variable rate of 6.7. They've got $200,000 sitting in an offset facility, which they can use to cover deposit and costs. They've got one credit card. Okay. They were given a pre-approval of $1.2 million. Why is that so? They don't have much debt. I wish my debt was only $300,000. Okay, they've got good income. They have a small credit card. They have good savings. With $200,000, they could almost do a 20% deposit. They're probably more likely to do a 10%, based upon that previous slide showing that needed $130,000. $200,000 gets them in and gives them a nice safety net in the bank for a rainy day as well. The reason servicing was so easy, bear in mind, I used, and I always use, proposed NDIS rent of about $140,000. That's a conservative figure because I don't necessarily know what you're going to buy. That $140,000 roughly is using a improved livability calculator. If you were doing a high physical support property in Perth, that figure is closer to $200,000, but because I don't necessarily know what you're buying, I take the conservative approach, and a loan of $1.2 million with $200,000 available to spend, that's total 1.4, it's going to get you into any NDIS property out there. The servicing, bearing in mind, on their existing owner-occupier loan, even though it's 6.7, we service them at 2.5% above that, so we're servicing them at 9.2. Okay. They allow for future RBA increases. The NDIS loan at 10% deposit, 7.89, so we're servicing them at 10.2 something, which is 2.5% above that. But we also include the proposed rental income, hence the approval for $1.2 million. That client may well go and buy something for $900, they're well and truly covered. If we supplied all those pay slips, all those bank slips, the identification, got everything in order with the names on statements, that loan will go through within the 6 weeks, no problem, without too much pain. Nice and easy one. Debbie, on to the next one. Case study number 2, more detail in this one. So Angad and Matty, PAYG as well. They've got an income of $400,000 between them. They have 3 kids at school. And if any of you that have kids, we know that kids are very expensive. They have their own occupier property worth 1.2, they owe 600, so they've got good equity as well. They're lucky enough to be on a fixed rate, 1.94 until May. They've got 5 investment properties totaling $4 million. They owe $2 million on that. Doing well, good equity in their house, good equity in their investments. They're on variable rates, and let's say they rented out at $500 a week. Could be a bit light, if they're in Sydney, those rents will be higher, but let's just use that for the example. $150,000 sitting in redraw in their home loans, which is enough for them to do a 10% plus costs. Big income, $400,000, good equity in their owner-occupier, good equity in their investments, all rented out. Their borrowing capacity was only $500,000. They were stunned. 500 plus the 150 equity release, it's not going to buy them too much at the price of a 650. The problem they had is, as I mentioned previously, those variable rates at 6.8, $2 million at 6.8 is suddenly $2 million at 9.3. The rent they receive, all lenders, particularly this one, shades those residential rents to 80%. They allow for possible vacancy. So albeit the client is making their loan repayments and their cash flow is good, the bank has bashed them by another 2.5% on top of their interest rates, and they've shaded their rent down to 80%. 90% loan at 7.89 suddenly is 10.39. They couldn't do anything. However, there are possible solutions for this client because we can see they are in a good financial position asset-wise. With NDIS loans, you can take a fixed rate. The fixed rate, 7.69, it's slightly lower than the variable. Obviously, moving forward, we're anticipating rates to decrease in the future, but that's not solving this problem for this client who is keen to get into a property now. On a fixed rate for 5 years at 7.69, that lender then services you at 7.69. They do not load it by another 2.5% because they know the repayment is not going to change. It makes a big difference to the borrowing capacity when you're servicing at 7.69 and not 10.39. Alternatively, and this has happened before, I've had multiple clients with multiple investments who are very keen to get into the NDIS space because of the returns, who have actually offloaded one of their investment properties. They may have one that's done them good service over the years, but it's not performing as well as that the NDIS one's going to do, so they've taken the jump and sold it to reduce some of their other debt. So that's two options for that client. Taking that fixed rate increased their borrowing capacity from 500 to 700. 700 plus the 150 gives them 850. That's getting them very close to getting into a property. So there are possibilities for some clients who are in this type of position to be able to do something to get into the NDIS space. The reason they were keen to do it is because the cost is increasing. 3 years ago, house and land packages for NDIS were in the 500s. Now there's nothing that I've seen under 800. So to keep waiting, that they're only going up, build costs continue to go up, land costs continue to go up. So these people were keen to get in. I can't recall which one I did. I think they took the sale of the investment property to free up some debt is the way they've moved forward. Number 3, thanks, Debbie. Self-employed, good. Clients are self-employed and run a manufacturing company. Net profits for 22 and 23 were very similar, 190 and 210. The way we normally do self-employed applicants, all banks are similar in this regard. If the variance between the last 2 years is less than 20%, we take an average. Okay, that variance is less than 20%. So what have we got? We used 200K as their income for serviceability, which is the average of those 2 years. Family home worth 1.2, they owe 400,000 on it. Couple of kids, no personal debt. Their company does have some finance, but that finance is paid by the company. You can see that in the profit and loss that it was making its own repayments. That does not affect the servicing calculator. If you had a car in your name and that car was not in the company's balance sheet, your company was paying the loan repayments, that car is your car, it is not the company's car, it would go into servicing. So just bear that in mind. No savings, okay? But lots of equity, need to do an equity release. A lot of clients come to me and say, I want to use my own broker. I'm not a broker, I don't deal with the banks, I purely deal with this lender, albeit we do home loans as well. I will always say to you as a client, go back to your broker. If your broker can get you an equity release through the bank that you bank with, more than happy for you to do that. Come back to me once you have an approval and we'll proceed with the NDIS loan. If you come back to me, as I said on the previous slide, that bank won't give me an equity release, then I will give the option of this lender doing your refinance plus equity release at the same time. These clients were lucky because of their profitability and the minimal debt that they were given a $200,000 equity release. Okay. We gave them a pre-approval for $850,000, so that gave them a purchasing power of just over $1 million. As soon as I got the equity release pre-approval from the other bank, I told them to go back to their referrer, i.e. NDIS Properties, and go and look at some house and land packages that you find suitable. Come back to me once you've done that, and obviously then we'll submit your application for formal approval. Nice, easy self-employed application. Number 4, please, Debbie. This one is a bit more complicated, and this is a real deal. Self-employed applicants running a restaurant. As a restaurant is irrelevant, I'm just using that industry for an example. Net loss for 2022 was $10,000. 2023, the net profit was $180,000. The income variance is substantially greater than 20%. The lender always takes the worst off figure, so they used a loss of $10,000. These clients paid themselves good wages, but the lender said the company is making a loss. It could not afford to pay those wages, or it reduced those wages via the loss, would not allow for depreciation, etc. This business was COVID affected. They said, come back to us once you've done 2024 figures that we can show are in line with 23s, and we will proceed. So that client could not do anything today, but when they come back with 24s, 23s and 24s will be similar. They will move forward, no problem. Number 5, thanks, Debbie. I think there's a number 5. Yes. Another good one, another real scenario. Male applicant, self-employed real estate agent, licensee as well. Taking home $200,000. Female applicant, registered nurse, $120,000. No kids, small car loan, couple of little credit cards. They don't own a house, they pay rent. They have good savings, $450,000. On the male applicant's Equifax or CRA or Vita report, as we have different names for these things, he was a director, shareholder of 5 other companies. We do not necessarily ask for all the financials of those other companies unless in his tax return he was deriving an income from all of those other companies. He wasn't. He was only deriving his income from one source, the real estate business that he ran. However, he had other companies. They may be non-trading companies. There could be a family trust that he just set up to do an NDIS purchase. It could be a company that's an SMSF company. He just may be director shareholders of other entities that he created that never traded or they've ceased trading. As long as the income is not derived from those, because they may well be co-owned with third parties who don't want to produce financials, we then will ask for an accountant's letter. And the accountant very easily, in 2 sentences, ABC Proprietary Limited does not trade, has never traded, and to the best of our knowledge, there's no debt owing to it. Or ABC Proprietary Limited used to trade, it was closed down 6 months ago and is in the process of being deregistered by ASIC. Simple way of getting around the need to get all those company details. Letter was supplied by the accountant. Approval was granted for a $900,000 loan. So that scenario for your self-employed applicants is, don't think if you've got multiple companies and multiple directorships that it is going to cause you a nightmare. It may not. That's where you and I will get together. You will tell me what you've got. We will do an Equifax on you. We'll clarify where your income's coming from, and a simple accountant's letter could solve some of those concerns you may have. Okay, Debbie, I'm not sure. Is there a number 6? No. That's case studies. I'm sure in the questions, some of you might have some scenarios to run past me. I'll let Ming manage that. Should we look at the couple of calculators, Debbie? If you want to. Guys, you can all access our website, accesslending.com.au. There's no passwords required. It is a public viewable website, which Debbie's going to bring up, and I'll quickly show you a couple of calculators that you can look at, which I use all the time. So that is our website. across the top there, you'll see some tasks that you can get into. The one we want to use is tools. So you'll just click on tools. You'll go down and click on calculators, which Debbie's done, which opens up this page. If you want to look at loan repayments, that tends to be the main one that people want to look at. You can click on loan repayments, and it is really, really, really simple. All you do is punch in the loan amount, which you can do that, Debbie, if you like. Make something up, 700,000 or whatever. Yep. You can change that interest rate to 7.89, which is our 90% rate. NDIS loans can only go for 25 years. So if you change that to 25, you cannot have a 30-year NDIS loan. Click anywhere on the box just to populate it, out to the side somewhere. Monthly repayment, $5,351. Okay. You can play with that loan amount as many times as you like. You can change the interest rate. You can't change the loan term. Okay. That'll give you your loan repayments based upon an NDIS loan. You can even use it for your existing loans or any other properties that you want to buy. If we go back and click on the tools button, Debbie, back onto calculators, we're going to scroll down to the bottom. Keep going, keep going, keep going. Stamp duty. That's the other one that I mainly use. So if you just click on whichever state, we're looking at Queensland, value of the land, leave it at that or change it if you want to, Debbie, it's okay. Click on investment, click on land. Underneath that, that'll give you your stamp duty, registration and transfer costs. Okay. So again, it is based upon land value. You must click on vacant land and you must click on investment. Otherwise you'll create wrong figures. You can do that. You can change that as much as you like, guys. They are the main two calculators that I use, apart from a servicing calculator. I wasn't going to show you the servicing calculator. It is a 3-page document that you can't access it. And it's just me punching in numbers, which is loan amounts, income earned, other debts, living expenses, etc. And it tells me how much you can borrow. But those calculators, there's other ones there that give you fortnightly repayments. They give you compound interest figures, whatever takes your fancy, whatever you're interested in looking at. You can use those calculators in that tools via our website to answer any questions you may have on that topic.
Great.
Well, Debbie,
yeah, I think that's it.
That's my PowerPoint. We'll open it up to questions, or if you and Min have anything to get the ball rolling.
Yeah, I think Min wanted to actually talk about a spreadsheet that we've got that talks
Debbie,
about...
I reckon we should just do some of the questions first, just to avoid death by PowerPoint.
We can do that, absolutely.
Lending can be a boring topic, so I hope I haven't bored you.
All right. So we got a bunch of questions here. Do you want to start, Min?
Yeah, from Des Pearson. When the returns are so good, why don't the banks lend for index properties?
Oh, look, they may come on to, look, we don't do medico loans. We don't do accountants packages or essential service loans. I suppose they have their niche at the moment. They may well do them in their commercial portfolio through their business banking, but they're not doing them as a normal home loan because albeit it looks like a house, it's not really a house. I suppose that's the only answer I can give at this stage. It's not to say they won't in the future.
Yeah, I think that they might be looking to come on board. Paul, you and I have both been to the SDA conferences quite a bit last year. And from what I understand, all the big 4 banks are actually signing up to...
They're coming to look, aren't they?
To go along to look, yeah, for some of the conferences this year. So yeah, I'd say that potentially the big banks might start to come on board in coming months and years.
Question number 2 is, if the SDA property has equity after 2 or 3 years, can we use equity in the original security to buy a second property?
Yes, no problems. No problem. You will go through the process again. They will revalue it. So it will cost you another $3,500. But these things are becoming more expensive. So I would presume that the value will keep on increasing. particularly as the rent keeps increasing, they're valued based upon rent. So look, I have one where a lady bought one in 2021. She paid $550,000 for it. 2 years later, it was valued at $750,000. So definitely the answer to that question is yes.
Next question is from David Savage. Welcome again, David. Why are conveyancing fees so high? Shouldn't they be more like $1,000 to $1,500? Can't see why they would be any different to any other, to a normal resi transfer. I'll answer this question. Most of the conveyancers and lawyers, they charge $1,000 to $1,500, correct, for the land contract. All right. There's another contract here called the build contract. So you're going to see another $1,000 to $1,500 additional cost to the conveyancing there. And you'll find that when you talk to all these conveyancers, they always charge that $1,000 to $1,500 for the land contract only, and they won't comment on the build contract. Okay. If you do come across someone who does two, there'll be the $3,000 cost for conveyancing. Okay. How do you value the properties? Paul, how do you value the properties, the valuations?
How do we value them? I'm not a valuer. They use a complex formula. So they are valued, the land is valued as land is, whether it be an NDIS property or a normal house being built on it, the land is the land. The construction is more expensive because of the features that go into the property. The valuers use a formula. I don't know the formula in its intricacy, but basically they take the property fully tenanted, so grossing $180,000. They multiply it by 10%, divide it by 15, times it by X amount of weeks. It's complicated, but it is based upon rent return. And I could not explain that formula to you. They will value it at $700,000 as a normal house, and they will value it at $900,000 as a SDA property using their complicated formula that they do not share with us, I'm sorry, but it is based upon the income derived, not what's sold around the corner. Sorry if that's not the answer you're looking for.
Next question is from Thompson again. Is it based on a cap rate if it is a going concern?
They
I
do
think
have
that's
a
normally
cap rate formula. They do have a cap rate formula that they use, but they won't share that with me. And if you do one of these and you've paid $3,500 for it, they will not give you a copy of the report either. Their liability through their PI insurance is to the lender. They give the lender the copy, albeit you've paid for it, so you would think it's yours, but they will not give it to you. If you want a copy of the report, you can go and get that valuer to do one for you. They'll charge you more because you're not the lender who's given them 500 deals a year, so they get a special rate. They will charge you a premium, but you can get a copy, but you will pay probably double.
Yes. Yeah. Next question is from Murray Spitz. Would entering into a partnership help or hinder with the lender assessing the loan, i.e. you have two employed people?
So can you say that question again? Entering into a partnership, did you say?
Yeah, if entering the partnership for the contract of purchase, will it help or hinder with the lender assessing the loan if you have two employed people?
So we do companies, trust and partnerships all the time. Normally it's mum and dad or two brothers or two sisters, etc. And both your financial positions come into it. We've had occasions where one person's on a really big income, it's got no savings, and the other person's got really big savings, a very small income. So they combined wealth, if you like, makes it very much achievable. You could have a situation where you have two mates who want to do it. One's got no debt, one's got 6 home loans, like one of the case studies, and can't borrow. So his friend or her friend may help them to get the loan, but it could also hinder because each person's personal position is joined in together and goes through servicing. So it's a yes and a no.
Very much a case-by-case basis.
Next question from AS. Will they accept draft financials for personal and company finances when you are self-employed, run as a business or a company, or must they be lodged?
Right, so up until last month, you could use 21 and 22s. And if there was any negativity in those figures, we would ask you for 23s. We would ask you for drafts, because I'm not going to make you go and pay for 23s figures and do all the tax, etc., if they were going to decline the deal. If 23's drafts were good, the lender would say, yes, we're happy to proceed. Client must complete them. Then you would have to complete them. At the moment, you now need to do 23s. We've had an instance where one client, they said, there was some write-offs in 22, which we're not really happy about. So they had to produce drafts for 24, which was July to December. So at the moment, the only drafts you would be able to get away with is 24's drafts. 23s are now due. If you haven't lodged them, I can work off your drafts, but you more than likely will be asked to lodge, but not until we at least give you the surety that it's going to proceed.
Does your lender for NDIS also do SMSF loans? Doing NDIS property through NDIS?
Yes, but we're not allowed to talk about that today. That's next subject. But yes, the answer is yes. But that's another subject that Ming and Debbie will invite you guys to.
We've already pre-recorded a podcast with Paul about 2 months ago. So we'll definitely be publishing that in the coming few weeks as well, prior to the webinar in about 2 months' time. Next question is, just in case, these case studies are all legitimate stories when people have been approved, or are they just scenarios in which approvals can be done? These case studies.
I think you said they were genuine case studies.
Yes, I may have changed the numbers slightly, but the nuts and bolts of the scenarios are real deals.
Sheikh Udin, I'm Paul's client. Just saying hi. Well done, Paul. Hey, no fans in here, please. Groupies go away.
You like the podcast as well, which is good.
Kate is asking, how long is a build time? Conscious of paying interest without return. Debbie?
Very good question. Look, the build time can vary from anywhere from 5 months to over 12 months, depending on the location, the builder, a lot of other variables. So yes, you need to make sure that the period of the expected construction is taken into account when looking at what you're going to have as a buffer and what you're borrowing. Very important. And we're going to actually touch on that with our calculator that we're going to show you, or our calculation that we're going to show you after this.
So this question from Kate about the build time frame. Look, I'll give you 5 different answers for 5 different states, okay? So in Melbourne, it could be as fast as 5-6 months to build a house for SDA. In Perth, there's the brownfield blocks and the greenfield blocks. The greenfield blocks, they're blocks in the brand new estates, which will take about a year, 15 months, 14 months to build a house. Because the approvals in there are very quick. They're looking at 3-4 months for their building approvals and the construction of 8 to 10 months right there. So there's your 14-month build time frame. But for the brownfield areas, which are the infill blocks, it's 2 years. It takes 1 year for an approval and then 1 year to build. So it's 2 years all up there, right? In Queensland, it's been 2.5 to 3 years to build a house, right? Because of post-COVID, COVID recovery, lack of trades, lack of supplies and weather, cyclones, floods. It's about 2 to 2.5 years to build it, okay? Yeah, there's my answer. Yeah. Moving on, next question. What's the general growth in NDIS property over time? Debbie?
Oh, Paul did touch on this a few years
Capital
ago.
growth. Capital growth.
Oh, capital growth.
Yeah.
Well, capital growth is a totally different situation to what property costs are, but it depends on where you are. You know, if you're buying in a new outlying area, you're probably not going to get great capital growth unless that suburb is well and truly up and coming. If you're building or buying in a more metro residential area, you're probably going to get better capital growth. But we don't really see these investments as a capital growth investment. If you get it, that's fantastic. It's more about your income and cash flow with these. Min, thoughts on that?
If you're spending 1.2 million and above, then you're going to get some growth, as in 2-3% per year, if they're in nice areas. If you're investing in a very if you're investing at sub 90 grand packages, which are further out from metro areas, 45 minutes to an hour out away from metro, I would assume 0 capital growth. Okay.
Yeah.
Just assume 0. That's it. Yeah. Moving on. Do you foresee the lender passing on decreased interest rates if or when the RBA decides to start cutting rates? Or
Yes, when RBA has moved upwards, they have very quickly moved upwards. They have sometimes moved more than the RBA upwards because there's no competition in this space. There's no one to take their deals off them at the moment. They recognise this. Their managing director has also put out communication that I can give to clients who are paying very high interest rates for the reasons for the high interest rates. And it's not necessarily a money grab, if you like. Their risk fee is a profitable fee for them. It is very expensive. A lot of lenders, smaller lenders more so than big ones, I would imagine, a struggle because ASIC and APRA charge you for holding land. Holding bricks and mortar is cheaper than holding land. And there are a lot of institutions out there who have very large land banks. And depending on their balance sheets, deposits, and all that sort of stuff, there are different liquidity ratios they have to have. And if your book is predominantly a construction book with lots of land in it, your cost of borrowing money in the wholesale market is more expensive than someone who has a large book of houses, without trying to get into economics too much. So they have been increasing at the same rate as RBA and somewhat more. We would hope and expect that they would do the same in the reverse market, because eventually some competition will come in. And as soon as competition comes in, or as soon as these properties are leased, some of the banks will then be happier to refinance an NDIS property that has lease agreements in place, not just on projected incomes from a government calculator. So hopefully the answer is yes in that space.
what vacancy rates do valuers use in valuing properties? I think we have to assure, well, I won't say we. The common understanding is the valuers know it takes time to pick up the anchor tenant and the secondary tenant. So they're assuming a 6 to 9 month vacancy at the very start of each house. That is, I mean, that doesn't really affect the valuation per se. That's just the understanding that we all know that could be 6, 7 months therefore for the anchor tenant coming in. Maybe the housing hub or the NDIA in their review back in July says that 15% is the average vacancy across all Australia on all the SDAs. I think 15%. Do you recall that?
I can't remember the number off the top of my head, no.
Yeah, it's about 15% is the NDIS forecast. Yeah. So that is my only answer for you there with regards to your vacancy there.
And it's worth noting that that vacancy doesn't necessarily mean vacant properties. It means vacant places.
Yeah.
In properties. So when you've got a 2-tenant home, you might have 1 room tenanted. You've got 1 room vacant, and that's where those vacancy rates are taken into account. So it might sound high, 15%, but that's because it's 15% that's not fully tenanted, if you look at it that way. Yeah.
Next question from Ganesh. Is it possible for the normal value to be higher than the SDA value, especially when the property value in the area goes up and the NDIS rent doesn't keep up? It's possible, but I don't see that as likely, no. The SDA valuation is always higher because of the commercial valuation process with regards to
the NDIS rent, firstly, it's going to go up with CPI every year. And secondly, we've seen that in general with the price reviews, they increase in line with the cost of development, basically. So I don't see that the NDIS rent won't keep up.
Next question is from Anonymous. How common is it to refinance SDA home loans and then convert to a residential loan? Is construction phase, can interest payments be capitalized? Paul?
Hang on a sec. I think you've read 2 questions there together, Min.
Oh, sorry.
Yeah.
Let's go again. How common is it to refinance SDA home loans to get a better rate or deal? I assume this is currently uncommon.
No, it doesn't happen because there's nowhere to refinance it to. This lender, every time a construction is finished, we go to them for a rate reduction because they charge a premium for construction loans. So as soon as it is built, we automatically say to them, right, this property is now finished. Our client wants a rate review. They have been dropping that rate by 30 to 40 points. So that 789 or 709 has been coming down 30 to 40 points.
Which equates to about what?
So 789 might come down to 759.
Oh, okay.
709 might come down to 659. Okay, so that they will do rate reviews. They are conscious that they made a premium during construction and they need to bring your rate back to more in line with a normal investment home loan. And bear in mind, I see home loans through major banks at the moment, investment loans in the 7s. You know, we do them in the 6s still. There's other places do them in 6s. So no one's ever going to be the cheapest. There's no one else to compete in the NDIS space, but they're not expensive on conversion back to normal rates. They're in the market.
Okay. Is the loan considered a construction loan and then converted to a residential loan? In the construction phase, can the interest payments be capitalised?
So the construction loan is a residential loan. It's just construction is a period of that loan. So it's a 25-year residential loan with a commercial flavour to it. The flavour being the rent and the valuation. It comes with offset. It has fortnightly repayments. It has internet banking. Everything that a normal residential home loan has, it has. During construction, you cannot capitalise the interest. You've got to make those repayments monthly because you can't take the loan above the 90%. So you've got to make repayments. They won't allow you to capitalise. That's where you would use your deposit, your savings, or your equity release to help you to make those payments during that time frame. After construction, it must go to P&I. Okay, so sorry, you cannot capitalise repayments.
Okay. Most of your case studies are based on people who already have investment properties. How would an NDIS participant who has funding for SDA go about building an SDA property for themselves as a first home buyer?
Same process. Obviously, you have approval for your SDA assistance, and that income that an investor would receive under the assumption you would be receiving that or a percentage of that. I'm not exactly sure what those numbers are, but I have done a couple of owner-occupier ones for people who want to buy their own house to live in, as long as they can confirm they have the SDA assistance.
Gotcha.
Same.
Yep. Next question. How do we buy NDIS property in SMSF if there's only one contract? Some people say SMSF price is 50 or 100K, more than one contract.
Okay,
Debbie,
I was actually typing this one because we are doing an SMSF webinar for those of you interested in this in May, in a couple of months. But yeah, look, in our experience, converting a 2-part construction house and land contract into a single contract costs more like 150 to 200,000 extra. It is a lot more. The way around doing this is to purchase an apartment or a villa, which is a single contract. And in some cases, we have builders come to us who actually own a block of land and they're building the property and they're selling it as a single contract. So you don't have to go through those costs of the conversion, which involves a third company, if you like, that actually undertakes the land, purchasing the land, the build contract, and sells it to your SMSF once it's constructed. So it's a very complicated and yes, a very expensive process. But if you buy a single contract property, then it's no more expensive.
Oh, you got me out of that one.
Next question. Is it true that some builders now are building IL, improvability, in other words, not HPS, just IL, because of demand? Is this good or bad? Debbie?
Yes. Look, we love IL properties because there's been a significant undersupply of IL properties being constructed, given that around about 40% of participants with SDA funding are funded for IL. And we have been advised by different providers that there are a number of those participants that don't have degenerative conditions and won't end up in a higher level house, and don't necessarily want to live in a disability looking home, which an FA and a high physical support home does look more, it looks different. You know, you've got the wider spaces of larger hallways and doorways, you've got a kitchen and a bathroom that might look a little bit more disability. So there's definitely a place for IL. There's definitely a demand for IL. So yeah, it's also great if you've got a lower entry point into this.
Okay, how is the refinancing look like by NDIS lenders? Any real-time examples?
We haven't refinanced anything out of this lender to another institution. Once they're tenanted, particularly once it's got 2 tenants in there, they're that profitable, the clients have been looking to refinance. It's only the ones that have been empty, or interest rates, they've fixed rates. Fixed rates have gone variable, that they're having some pain, that they're trying to restructure their finances to get everything to more achievable for their monthly repayments. But no one's been refinancing them.
Yeah.
No one's selling them either. I haven't had any that's been sold. They're buying them and they're keeping them.
Yeah.
My broker said he's not able to use Access Lending because they are not on some panel. What does this mean?
Okay. So brokers deal with banks via aggregators. So a bank does not want to talk to 5,000 brokers. So there are aggregators out there who, if you like, are companies who manage brokers in a collective. So that each aggregator might have 2,000 brokers on their books. If the broker has an Australian credit license, an ACL, it's like a real estate agent has a licensee, we deal with licensees. Okay. If you are a credit representative, so you're using your aggregator's license, we are not on aggregator panels. We only deal with brokers who are licensed, because we're not dealing with the aggregator, we're dealing with the broker as an individual. So we do have brokers who we do business with, but they hold an ACL.
I might go through one more question here. There's more Debbie and me to talk about. Previous build contract, which have not commenced construction, do not include sprinklers, and the build classification is class 1, which should be class 3. Does the classification and sprinklers make a difference from a lending perspective? Well, no, it's just the cost to the construction. I mean, it's an additional cost to build it. Yeah, that's all. It doesn't impact upon the lending. No,
lenders not looking for sprinklers at all. Then they're not looking for sprinklers. That's the valuation is done. That the rent might be different in the rent calculator if there's sprinklers and breakout rooms, but the lender's not looking for those. It is probably something that you guys as customers will speak more to with Ming and Debbie, because some local councils are insisting upon these items being included in the build. So that's probably a topic that you might want to run, Ming, at a different time.
Cool. Debbie, we should open up the spreadsheet that we have that we use internally.
Yes, very quickly, because
combines, yeah.
We were going to do that. Just to wrap up this, let me share. Okay, hope you can all see that.
Okay, so this is an example of a $900,000 purchase in Victoria, 350 land, 550 build, 900 grand, just for round numbers purposes in Victoria. If you scroll down there, number 2 and 3, property costs and financing costs, they have been already covered in one of Paul's other examples to our office about a few weeks ago. And so stamp duty, registration of titles, search fees, other costs there, financing costs, valuation costs, all those costs there totaling up to about $38,000. Now, if you plug it into the top part there, Debbie, I'll just scroll back up a little bit, you'll see that based on an 80-20 ratio of LVRs, can you increase the view there, make it larger, Debbie?
I can make it larger, yeah.
125% maybe. You'll see that we've shown here, showing you, there we go, on this 900 grand purchase, that our recommendation to buyers is about $391,000, just short of 400 grand as your cash requirements. Now, Debbie, let's talk about the buffer, Debbie, the road number 2021 there, construction loan buffer and buffer during vacancy. Let's talk about that for a second. I know one ever talks about it.
Absolutely. Yeah. So obviously a lot of these costs would be the same as if you were to build a normal house and land, things like your legals and your rates, etc. But with an SDA comes other costs, your SDA provider costs. Now, you can't get income on one of these properties without it being managed by an SDA provider who is a registered NDIS provider, and they are the property manager. They are the only organization that can enroll the property as SDA with the NDIS. They charge an engagement fee. They also charge a participant procurement fee. That can be up to $25,000 one-off cost. You might need to provide furniture in the house, whether it's a partial package of just like living room, dining room furniture, or a little bit more. So you could be looking at up to $25,000 there. Of course, your loan repayments, construction loan payments, if the build takes 12 months, obviously if it takes more, it's going to go even higher than that 46,000 we've estimated there. And other buffer needed, your P&I mortgage repayments after construction, because you won't necessarily get a participant in straight away. Even if your property is enrolled within 4 weeks of the property being completed and the provider enrolling it, you still got time for that tenant to move in. It might be a few weeks, it might be a month or two. And then you don't get the SDA payments until the service agreement has been submitted and is correct with the NDIA before they actually start paying the SDA payments. All going well, you'll still get payment a month in arrears. So you're still looking at 2, 3, 4 months, even with tenants moving in pretty much straight away before you start getting your income. And there we do know of delays where the, and it's the NDIS's fault basically, where they're slow to get those service agreements in place. A service agreement has to be submitted by the SDA provider before the NDIS start paying that SDA, and it's purely up to the NDIS to get that finalized and ticked off. And until that happens, they won't pay on the SDA. So you could be many months, even with tenants in place, before you're actually receiving that income. Once you've got it, it's coming in. But you need to be aware that you're going to need to have some kind of a cash buffer for that sort of unexpected situation that may happen.
Yep. And during your first year of vacancy, you still have to cover costs of insurance, rates, fire sprinkler maintenance and audits, the building inspector costs before handover there, the depreciation costs. So these are all costs that are very much relevant that no one ever talks about or covers.
Yeah.
And we thought we'd throw it into this spreadsheet to show you, right? Show you that these are the costs you're up for. And we've put the word optional there to show you that those costs are optional, obviously. But if you think you can get away with 10% deposit, no, ain't gonna happen.
That's right.
There's just so many costs here that you have to really be prepared for at completion and also post-completion.
Yeah, because you don't want to be in a situation where you're worrying over how you're going to pay off your mortgage repayments every month because you haven't got tenants in place paying it. And you need to be sure that that is something that you can cover.
There was a podcast we published last Friday, Debbie, with you and Everhomes, you and Dan Ackfield and Jessica. And Dan said that he has so many clients ring him up saying we only have 1 month buffer and they can't afford to hold on to it after a month. So have to sell the house. And it's sad to see that there are many people who don't understand that through no fault of their own, providers don't control or influence the actual the occupancy rate, because sometimes there's just not enough participants in the area, and the delay of construction causes participants to move on as well, Debbie.
That's right. Yeah. Or they may be participants, but there's delay in getting their funding in place for whatever reason. So there's a lot of reasons.
And then also, Debbie, delay of payments being received
as
well,
I mentioned,
right?
with the NDIS's processes
Yeah.
sometimes
So
being
we
slow.
have one client who, our first client, Craig, in northern Queensland. He's had his house a year now, tenanted for a year, zero rent coming in from the NDIS. He's absolutely angry. He's absolutely livid. He's just so angry that the NDIS red tape has caused him delays of 12 months to receive any income at all. Now, he will get back paid, yes. But the fact that he has gone 12 months with no payment received, and the NDIS provider they can't do anything about it. They're lodging complaints to the NDIS. They're ringing around, but just the bureaucracy, red tape of the NDIS process system with their new PACE system they've installed into the whole platform is causing massive headaches to everyone, participants, providers, and investors in receiving the relevant SDA rental income. So delay of construction, delay of approval of the SDA funding coming in for the participants, and also delay of SDA receipt of payments from the NDIS as well. So that's why you got to have the buffer in there. 9 months is a good number to buffer in. So there you go. Have that ready.
Yeah, so we thought that was important to just cover if you are looking at this. Thanks, Min, for running through that.
All good.
Okay.
Paul, any final words of well, actually, there's a few more questions here. Debbie, read the questions, please. Very
quickly. So, Kate, sorry, I think I may have missed the answer on this. Is this a variable rate, and is the movement in line with RBA? Paul, you did say generally it is, yes?
Yes, it is. It is a variable rate, and they have been moving it up with the RBA, and occasionally more than the RBA, based upon the land bank stuff that I talked about earlier and costs to them. So we're just hoping in the future they'll obviously move down as well with the RBA.
Yeah. And from Des, for an HPS property, how long will it take to pay back a 1 million loan, assuming all the NDIS money is ploughed back into the loan?
That depends on your tax rate, tax payable on your total income each year, obviously.
Look, I suppose if you wanted to do the example, if you're looking at one in Perth, a 2-participant high physical support is going to gross you 200,000. Allowing for those other costs that Min's just put into his calculator, which are hard to
well,
work
those are upfront one-off costs. But if you're
if
talking about
if the mortgage is 50,000 a year, if the mortgage is 50,000 a year, and you're netting 100,000 a year, maybe, or 120, well, that's 80,000 a year. You're paying off the principal. You could probably do the numbers on that.
12 years.
Yeah. Yeah. And just a comment from Lorraine in our office here, having sprinklers may help with insurance premiums, or it was a question. So I believe that is a case. That's not so relevant with the financing, but Min?
Well, I mean, we've been talking to some of those insurance brokers for the last 2 years now, and they've been struggling to get the right insurance package together. So we may need to ask our contacts in the insurance world that they answer.
I believe that is true. But yeah, we'll clarify that. But I think that covers everything. So just a reminder, everyone, that you will be getting a copy of this recording along with the slides from Paul. And yeah, thank you very much to everyone for taking your precious time today, and especially if you're in WA and it's a public holiday over there. Thank you, Paul, for joining us. And we look forward to the next one, which is going to be in May, and we're going to be talking all about SMSF finance for those of you who are interested. So keep your eye out for that.
And Debbie, thank you. And if anybody does ring the 1300 number on that slideshow, NDIS Lending's office is in Sydney, so you will be put through to Sydney. You'll have to ask for me. I live in Perth, so they will give you my details or pass your details on to me. And
in the slides, I didn't show the last one actually, is Paul's email address as well, so you can email him directly. If you look at the last slide on that slide, the slides you're going to receive from us. So thank you very much, everybody, and look forward to seeing you next time.
Good. Thank you.